Hello there and welcome. And thank you for joining me tonight on the latest episode of Explore the Market series. Tonight's episode of Exploring the Markets, episode 2, is called What is Forex? Written by myself, which is Alexander Mycroft, and I'm the Chief Market Analyst here at Olympus Markets. Now, a little brief introduction on myself. I'm the Chief Market Analyst here at Olympus Markets, and I have over 20 years experience in the financial service industry. I've specialized in pensions and alternative investments before obviously moving into trading, where I've traded for several prop companies, one in particular through Dubai Gold Commodity Exchange, where I specialized in gold options. Moved into portfolio management, where at one point I had a total portfolio cap value of 18 million. And I then moved into education. I'm indeed a published writer. I've been published in several leading industry publications. I'm a very passionate market commentator. I'm very passionate about this marketplace. And I'm also a well-known public speaker, and I've spoken at several events around the globe. Tonight's episode, like I say, is episode 2, is really back to basics on what Forex is. So in many ways, it is for beginners, but it's also for those out there who have been trading money for many months, maybe even a year or so, and have never really grasped the mechanics of what they're actually trading. Because quite a few people who want to be traders, they jump into the market not understanding the mechanics, not understanding the simple things, thinking that the way to be successful is understanding technical analysis, things of that nature straight away, and don't focus on, like I refer to as the mechanics of the instrument you are trading. So, like I say, it's for everybody, but we will really sort of talk about what is the Forex market. Then we'll discuss what is a pip and how you can calculate it. Then we'll discuss what is leverage and what is a big deal, and why is it a big deal, sorry. Then we'll talk about the different trading sessions, and then we'll discuss market jargon. I'll try and simplify it all for you. Then we'll discuss briefly the battle of the bulls and the bears, and then I have a little teaser of future things I'll be doing for Olympus in the future. So what is the Forex market? Forex, or FX, is the abbreviation of foreign exchange market. The Forex market is in fact the biggest financial market in the world, and it's bigger than all of the individual stock exchanges put together. Its average turnover is around about 5 trillion a day. And because of this, and what also helps it be so liquid and so large, it's not controlled by a single exchange. I.e., for example, if you traded certain stocks, you would have to wait for the New York Stock Exchange to open, or London, or something of this matter. The Forex market is not controlled by a single exchange, so as we'll discuss later, it is available 24 hours a day, 5 days a week. So, with a market this large, who's in there trading? What does it consist of? Well, it consists of those investment banks, central banks, countries' central banks, commercial banks, hedge funds, retail brokers, and individual investors like yourself. Now, there's 2 levels of the market. There's the interbank market. This is where all the large players are. The large banks trade currencies for hedging purposes and for balancing accounts. And then there's the other market, which is called the over-the-counter market, or OTC market, which again is for individual speculators. And these individuals trade through brokers like Olympus and online trading platforms, etc. So they use obviously brokers as over-the-counter trading, or over-the-counter market. So what is the Forex market? So Forex market, obviously, we're talking about currencies. And every instrument available on the Forex market is traded in pairs. For example, we have the euro against the dollar, or the British pound against the US dollar, or the US dollar, Japanese yen. This practice involves speculating on the value of one currency against the other. So, for example, if you were trading the euro dollar, if you believed that the euro was going to go up in value, then you will speculate in one direction. If you believe the euro is going to fall in value against the US dollar, you'll speculate on the other direction. And like I say, if you get the direction right, then of course you do indeed have the potential to have a profitable trade. If you get the direction wrong, however, then of course you have the potential to have a losing trade. Now, it's not only because they're trading in pairs, but when you're trading a currency pair, you'll see two rates. Again, we're keeping with the euro dollar because it's the most liquid pair. On one side, you have what's known as the bid. On the other side, you have what's known as the ask. And the very difference between the two numbers is called the spread. And that is the commission you pay your broker for that transaction. Now, the one on the sale, so on the bid, okay, is the price you would sell the asset at if you believed it was going to fall. So that's the sell bid. And the other, as in the ask, is what you would buy that asset at if you believed it was going up in value. So let me put this another way. Let me get my little laser pen. Here we go. If I believed, for example, the euro was going to go down in value against the dollar, I would sell it, and that would be the rate I would sell it at. If I believed the euro was going to go up in value against the dollar, I would buy it, and that would be the rate I would buy it at. Now, the whole point of this, or the whole point of us being able to potentially make money or potentially lose money, is the movement of what is called a pip. Okay, it's the pip. And that does indeed have the ability to make us money or lose money, depending how many pips an asset actually moves. Now, what is actually a pip? A pip stands for percentage in point. And it's a unit of measurement to calculate the change in value of one currency against the other. Now, most of the major currency pairs, the pip is the fourth decimal point. The exception being, of course, is the US dollar, Japanese yen, where it's the second decimal point. So let me break this down in simpler form and more of a clear illustration. So here's our euro dollar. We have our sell price, which is 1.1689. We have our buy price, which is 1.169. The pip is the fourth decimal point. So here is the pip we're watching, the fourth decimal point. My previous example, it was 1.1689. In this example, the sell price is now 1.1688, which means the euro has dropped 1 pip. And it's that movement which again turns into potential profit or potential loss. And this is how we calculate this. Now, there's two major factors. One is contract size. The second is leverage. Leverage we'll discuss in a moment. But let's talk about contract size and the value of the pip. Here's an example. Say we're trading the euro dollar. We sold the euro dollar 1.1688. We're selling a standard lot size, which is 100,000, so a contract size of 100,000. So we know it's the fourth decimal point, so 0.001, divided by the rate we sold it at, which is 1.1688, gives us a number of 0.000855578. We times that number by the contract size, 100,000. Which gives us a pip value of €8.56. We convert that into dollars, which means it's $10. So basically that pip is now valued, one single pip is valued at $10, or €8.56. That is the value of a single pip. Let's do another example. We're trading euro dollar. We sold it at 1.1688. Lot size of 50,000. So 0.0001 divided by 1.1688 gives us a number of 0.00008555578. Times it this time by a smaller contract size of half a lot, which is 50,000, gives us the value of €4.27. Convert that in dollars, that's $5. So each pip trading a contract size of 50,000 is now valued at $5 as opposed to $10 on a standard lot of 100,000. So there's one factor to take into account how to calculate pip, but it's something else. And this is something very important which most people do not understand or take the time to understand it, and that is leverage.